Are you really buying the safe dividend stock? The critical three-step check most Singapore investors overlook. Hey investors, Iggy here. Welcome to Instructor Mode. Today's lesson is all about safeguarding your portfolio. Are your Singapore dividend stocks really as safe as they look? Or are you stepping into a trap that could shrink your income? Most investors see blue chip names like DBS and Singtel and assume all is well, but that's not always the case. This is Module 1 of our free investing course. By the end of this workshop, you'll know how to screen any SGX or Bursa Malaysia dividend stock using my three-step safety check. You'll learn to spot hidden risks before you invest, using a proven framework you can repeat across your portfolio. I'm Iggy, the voice behind the investing Iguana. I create simple, repeatable frameworks for SGMI investors, focusing on skills you can use for CPF, SRS, EPF, and cash accounts. This module is adapted from our full Substack course. If you want worksheets and checklists, go grab them from the course. The link's in the description. Here's how we'll break down today's workshop. First, how to check the payout ratio. Second, how to analyze debt levels. Third, how to audit dividend history. What is the payout? The payout ratio? The payout ratio is the percentage of a company's net profit that gets paid out as dividends. Why does this matter for you? It shows whether a business can afford its current dividend or whether it's on shaky ground. Let's get practical. Look at the table for two famous Singapore stocks. DBS, dividend per share, $1.44, net profit per share, $3.60, payout ratio, 40%. Singtel, dividend per share, $113, net profit per share, $134, payout ratio, 84%. Look at DBS, payout ratio, 40%. That's healthy. Plenty of profit left over after paying dividends, so there's cushion if business slows down. Singtel, 84%. That's a warning sign. Most of the profit is going out the door, leaving less room for tough years. For SGMI stocks, under 70% is usually healthy. Banks like DBS normally hover between 40 and 60%. Telcos, including Singtel, may reach 60 to 80%. Anything above 90% is a red flag. You'll find payout ratios at the bottom of annual report highlights, on financial websites like SGX or Yahoo Finance, and on the company's own site. My tip, always look for the 3 to 5 year trend, not just 1 year, so you spot recurring problems, not random blips. Don't look at 1 year and call it safe. You need a trend. If you see a high payout ratio for 3 years in a row, there's trouble. A sudden spike could mean a special payout, but could also mean shrinking profits. If you're using CPF or SRS to buy dividend stocks, safety matters double. These funds are less liquid. You don't want surprises. Okay, now you know how to check if the dividend is affordable. But that's just the start. Next, can the company itself survive rocky markets? That's where debt comes in. Debt is borrowed money. Too much debt means higher interest payments and less cash for dividends if things get tough. Why do we care? Even a profitable company can stumble if it's drowning in debt, especially as global interest rates rise. Banks use debt differently than telcos or REITs. It's not just the amount, but the business model. Look for the debt-to-equity ratio or net debt EBITDA in the financial section. For banks, focus on capital adequacy ratio, the main safety measure. Let's compare DBS and Singtel. DBS, debt-to-equity ratio 0.10, interest coverage high, banks use leverage. Singtel, debt-to-equity ratio 130, interest coverage moderate, telco more normal. Look at DBS's low debt, just 0.1. Their business depends on managing risk and capital, so debt is tightly controlled. Singtel sits at 130, still manageable for a telco, but if that number climbs much higher, dividends get shaky. Don't treat all sectors the same. High debt is riskier in telcos or REITs than in banks. Always check the sector context before you judge. If you invest in S-REITs, pay extra attention to debt. Rising interest rates can lead to cuts. Don't skip this step for CPF or SRS portfolios, since high debt can hit your long-term returns. Now you've checked payout ratios and debt. What next? It's time to look at dividend history. A safe dividend is no good if it gets slashed next year. Dividend history tracks what companies actually paid, year after year. It's the real-world record, showing if the dividend grew, shrank, or disappeared. Consistent and growing dividends are what you're looking for. Sudden drops or cuts, those mean trouble. Here's the 5-year dividend history for DBS and Singtel. 2018, DBS $1.20, Singtel 0.175. 2019, DBS 1.32, Singtel 0.75. 2020, DBS 87, Singtel died 153. 2021, DBS 1.20, Singtel 0.75. 2022, DBS 1.44, Singtel 0.113. See DBS in 2020, there's a dip, but it rebounds quickly. Singtel not only drops in 2021, but doesn't fully recover. When you see this, ask, is the company able to bounce back? Do dividends trend upward, or are they flat or falling? Always zoom out for the bigger picture. Don't just accept blue chips as status. Even big names cut dividends. Always run this test on every stock, every year. So what does this all mean for you as an SGMI investor? Using this filter, let's summarize. DBS, payout ratio, 40%, debt level, very low, 5-year dividend, trend consistent side growth, verdict pass. Singtel, payout ratio, 84%, debt level moderate, 5-year dividend, trend cut, flat, verdict caution. UOB, payout ratio, 42%, debt level very low, 5-year dividend, trend consistent side growth, verdict pass. Mapletree, payout ratio, 88%, debt level moderate, 5-year dividend, trend flat, verdict caution. This shows exactly how the framework sorts strong core stocks from those that need careful watching. If you're locking up money for years, safety is your first line of defense. You do not want stuck funds in a dividend trap. Use this system every year, before you buy and for every stock you hold. Ignore headline yields. Focus on payout, debt, and dividend history. Let's recap Module 1 with a simple checklist. Check the payout ratio. Look for under 70%. Banks even lower. Analyze debt. Low ratios for banks. Manageable for telcos. Watch REITs. Review a dividend history. Look for consistency and a trend. Run this check yearly on every SGMI dividend stock, especially CPF SRS holdings. Prioritize stocks that pass all 3 checks. Avoid dividend traps. You now have a framework that most retail investors ignore. You can use this tonight to review your investment portfolio. Before you go, smash that like button if you found this helpful, and subscribe so you never miss a free module. Share this video with anyone in SGMI who invests for income. They'll thank you for the sanity check. The worksheets and full course modules are waiting for you on Substack. It's free to join. What's next? Now that you've mastered safety, you're ready for Module 2. In the next lesson, we'll go beyond dividend safety and learn to spot growth. How to find stocks that not only pay you, but pay you more every year. Click the video on the screen to jump to the next module. If you want deeper dives, monthly portfolio templates, and one-on-one Q&A, try the premium membership at the Investing Iguana. It's your shortcut to smarter, safer investing in Singapore and Malaysia. Thanks for tuning in. See you at Module 2.